All right, so another day. I mean, I know I've been really behind about streaming, but here we go. Off to work. Streaming managerial accounting. So we're talking about variable costing and segment reporting tools for management. Let's go ahead and do this. I have, see, about 2 hours. Yeah, 2 hours would put us at 140. That's enough time. Okay. Variable costing and regiment or segment reporting tools for management. For decades, Microsoft Corporation and its iconic franchise Windows were synonymous. Even today, 1.5 billion devices still use some version of Windows software. Nonetheless, the company has diversified beyond Windows, given the industry's irreversible migration from the personal computing to mobile devices and the web, placing greater emphasis on Azure, its cloud computing operation, as well as Office 365 and dynamic business software services segments. While Microsoft's personal computing business, which includes Windows, still accounts for 42% of the company's total revenue, the revenue growth rate from this segment is only 2%. Conversely, Azure's revenue has jumped by 98% and Office's 365 sales have grown by 41%. So we should be able to explain how variable costing differs from absorption costing and compute unit product costs under each method. Compare income statements using both variable and absorption costing. Reconcile variable costing and absorption costing net operating incomes and explain why the two amounts differ. Prepare segmented income statements and differentiates traceable fixed costs and common fixed costs and use it to make decisions. Compute company-wide and segment breakdown points for company and traceable fixed costs with traceable. Okay, and prepare an income statement using super variable costing and reconcile this approach with variable costing. This chapter describes two applications of the contribution format income statement that was introduced in earlier chapters. First, it explains how manufacturing companies can prepare variable costing income statements which rely on the contribution format for internal decision making purposes. The variable costing approach will be contrasted with absorption costing income statements, which are generally used for external reports. Ordinarily, variable costing and absorption costing produce different net operating income figures. The difference can be quite large. In addition to showing how these two methods differ, we will describe the advantages of variable costing for internal reporting purposes, and we will show how management decisions can be affected by costing method chosen. Second, in the chapter explains how the contribution format can be used to prepare segmented income statements. In addition to company-wide income statements, managers need to measure the profitability of individual segments of their organization. A segment is a part or activity of an organization about which managers would like cost, revenue, or profit data. This chapter explains how to create contribution format income statements that report profit data for business segments such as divisions, individual stores, geographic regions, customers, and product lines. Very valuable info. First off, the two things that we're talking about here, that variable costing and absorption costing, they're going to probably show us an image here in the next page. But the big difference between these two is variable costing isn't everything. whereas absorption costing is, basically, in a nutshell. So, overview of variable and absorption costing. Explain how they differ. Explain how variable costing differs from absorption costing, and compute unit product costs under each method. All right, so here we go. They probably have an image here, so we'll get to that. As you begin to read about variable and absorption costing income statements in the coming pages, focus your attention on three key concepts. First, both income statement formats include product costs and period costs, although they define these cost classifications differently. Second, so that's important. So product costs and period costs do vary. So anyway, second, variable costing and income statements are grounded in the contribution format. They categorize expenses based on cost behavior. Yes, so if it's going to change with the increase or decrease of the product, then it's a variable expense. Variable expenses are reported separately from fixed expenses. Yep. Absorption costing income statements ignore variable and fixed cost distinctions. It's everything, like I said earlier. Third, as mentioned in the paragraph above, variable and absorption costing net operating incomes often differ from one another. The reason for the difference always relates to the fact that variable costing and absorption costing income statements account for fixed manufacturing overhead differently. Yes, I was gonna, yeah. That's actually, I like this, the way they're saying this. It makes sense. All right, variable costing. Under variable costing, only those manufacturing costs that vary, things that are variables, with output are treated as product costs. This would usually include direct materials, direct labor, and the variable portion of manufacturing overhead. That would probably be like indirect materials, anything that, so like the glue that you use, things that can't directly be attributed to the product, like you can't quantify how much glue you used, in a chair. Like, I mean, you could, it's just unreasonable. Rather fixed, okay, that's not the right spot. Fixed manufacturing overhead is not treated as a product cost under this method. Rather, fixed manufacturing overhead is treated as a period cost, like, okay, wait. This would usually include direct materials, direct labor, and a variable portion of manufacturing overhead. Fixed manufacturing overhead is not treated as a product cost under this method. Rather, fixed manufacturing overhead is treated as a period cost, and like selling and administrative expenses, it is reported as an expense on the income statement in its entirety each period. Consequently, the cost of a unit of product in inventory or in cost of goods sold under the variable costing method does not contain any fixed manufacturing overhead costs. Goes into fixed manufacturing overhead cost. Variable costing is sometimes called as or referred to as direct costing or marginal costing. All right. Absorption costing. Absorption costing treats all manufacturing costs as product costs, all of them, regardless of whether they are variable or fixed. The cost of a unit of product under absorption costing method consists of direct materials, direct labor, and both variable and fixed manufacturing overhead. Thus, absorption costing allocates a portion of fixed manufacturing overhead cost to each unit of product, along with the variable manufacturing costs. Because absorption costing includes all manufacturing costs in a product, it is frequently referred to as the full cost method. Selling and administrative expenses. These are period costs. They're never have been or ever will be treated as product costs, regardless of the costing method. Thus, under absorption and variable costing, various variable and fixed selling administrative hours treated as period and expenses on the income statement, of course. Summary of differences. Here we go. In conclusion, the reason variable costing and absorption costing often report different net operating incomes, as illustrated in our picture here, is because of the two methods account for fixed manufacturing overhead costs differently. All other costs have the same effect on net operating income under the two methods. In absorption costing, fixed manufacturing overhead costs are included in work in progress inventory. When units are completed, these costs are transferred to finished goods, and only when the units are sold do these costs flow to the income statement as part of cost of goods sold. So that flow looks like this. Yeah, here and then there. In variable costing, fixed manufacturing overhead costs are considered to be period cost. So again, this is our MOH is split into two here. You have to differentiate the difference between a variable manufacturing overhead and a fixed. And then the fixed go here, and then the variable go to work in process. I always want to say work in progress. All right. All right. What was I saying? Are taken immediately to income statement as period expenses. Cool. Next page. Variable and absorption costing. An example. We will be making four simplifying assumptions throughout the forthcoming example entire chapter. First, this chapter uses actual costing rather than normal costing approach that was used in the job order costing chapters. In other words, rather than relying on our POER rates to apply overhead costs to products, this chapter assigns actual variable and fixed manufacturing overhead costs to products. Second, this chapter always uses the actual number of units produced as the allocation base for assigning actual fixed manufacturing overhead cost products. I'm going to have to remember this. Third, this chapter always assumes that the variable manufacturing cost per unit and the total fixed manufacturing overhead cost per period remain constant. Fourth, all examples, exercises, and problems in this chapter assume there is no beginning or ending work in process inventory. Cool. So we're just cutting out a lot of stuff. Having stated those assumptions, let's illustrate the difference. Okay. So we have a selling price of $100,000 per aircraft, direct materials, direct labor, variable manufacturing overhead, fixed. I like that they have the per month. That just clears things up so much. All right, so let's do some math here. So we have 100,000 as our selling price. We're going to subtract 19,000 plus 5,000 plus 100, or I'm sorry, 1,000, and 10 plus 10. So that gives us, let's see, 25, 35,000. So this gives us our contribution rate, or contribution margin, I should say. $65,000. Okay. And then we can subtract that by our fixed costs, which would be 70. I mean, is this, I guess, did we have a date? Nope. So we have 65,000. We're going to be in the negatives when I add these fixed costs. But these are per aircraft. So we make about 65,000 per aircraft. If we only sell one per month, we are going to be in the negative. By how much? It'll be 10,000. So we're negative 20,000 by February. And let's do 65 times 5. And then positive 250,000 in March minus our debt of 20,000. So we're looking at 230,000 end of March. Now, how many inventory do we have? We got we produced 1, 2, 3, 4, 5, 6, 7, 8. No, 7. We produced 7 total, and we sold 7. So we're 0 inventory. All right, variable costing, contribution, prepare statement. Yeah, so wait, whoa. Why aren't we doing our variable selling and administrative expenses? I guess that's not to make. That's per sale, I guess. That makes sense. All right, well, fair enough. So it's 25,000 instead, so that's okay. They'll get to the same answer because each month's product variable costing sold for all that can be computed as follows. Cool. Yep, and that's how many they sold, selling administrative expenses, variable costs of goods sold, variable costing unit product cost, variable costing contribution format income statements. Okay, I see what they're doing. Cost of goods sold, variable selling and administrative, total variable expenses, contribution margin, that's that same number I had, 65. 325. Oh, I was off. I was off by a bit. Fixed selling and administrative. Did I miss that? I did miss that. Did I? Thought I got that. Must have missed it because I was off a bit. I was off by 5,000. All right. I'm okay with that. I understand how this works. This is what I did initially. Yeah. Yeah, I think I did 85 instead of 90. Okay, absorption costing income statement. As we begin this example, remember that it differs from variable. Yeah, it's a little fuzzy in my head, but we have our direct materials, direct labor, variable manufacturing overhead. Oh, yeah, it's a little weird that they're doing it, but I think the reason it's being done this way is because um, our POER rate doesn't. I mean, these are the fixed costs, so you're just gonna split it evenly. I don't know. I don't know. See if we can figure it out. Notice that in each month, fixed manufacturing is 70,000. Oh, overhead. Is this per unit cost here? That doesn't make any sense to me. All right, let's just move on. All right. The sales for all 3 months are the same as the sales shown in the variable costing. The January cost of goods sold consists of 1 unit produced during January at a cost of 95,000 according to the absorption costing system. The February cost of goods sold consists of 1 unit produced during February at the cost of 60,000 according to the absorption costing system. The March cost of goods sold, 230,000, consists of 1 unit produced during February at an absorption cost of 60,000 plus 4 units produced in March, which a total absorption cost of 170 or times this per unit. The selling and administrative expenses equals the amount reported in the variable costing income statements. However, they are reported as one amount rather than being separated into variable and fixed components. Note that even though sales were exactly the same in January and February, the cost structure did not change. Net operating income was 35,000 higher in February than in January under absorption. This occurs because one aircraft produced in February is not sold until March. This aircraft has 35,000 of fixed manufacturing overhead attached to it that was incurred in February, but will not be recorded as part of cost of goods sold until March. That makes sense. So going back up to this example here. Oh, it's on the other page. Going back to the other page of this example. So the fixed manufacturing overhead goes right to period expenses and variable costing. But in absorption costing, it goes into work in process, so it's not going to get recorded until a sale is made. It's kind of hidden. Contrasting the variable costing and absorption costing income statements in Exhibit 6-2 and 6-3 note that the net operating income is the same in January under variable costing and absorption costing, but differs in the other 2 months. We will discuss this in more depth shortly. Also note that the format of the variable costing income statement differs from the absorption costing income statement. I did notice that. An absorption costing income statement categorizes costs by function: manufacturing versus selling and administrative. All of the manufacturing costs flow through the absorption costing cost of goods sold, and all of the selling and administrative expenses are listed separately as period expenses. In contrast, in the contribution approach, costs are categorized according to how they behave. All of the variable expenses are listed together and all the fixed expenses are listed together. The variable expenses category includes manufacturing as well as selling and administrative expenses. The fixed expenses category includes both manufacturing costs and selling and administrative expenses again. Superglue, the variable overhead cost that holds our products together. Oh, witty. Adhesives that are gradually replacing welds, rivets, screws, and bolts in automobiles and airplanes for companies that manufacture structural adhesives such as Henkel AG, Dow Chemical, and 3M. The 4% to 5% annual growth rate in this $2 billion market is good news. Automakers are replacing heavy metal fasteners with light adhesives in an effort to meet tougher fuel economy standards. For example, the Ford Motor Company F-150 pickup truck is using 3 times as much adhesive as prior models. In the aerospace industry, the Boeing 787 Dreamliner uses between 200,000 250,000 fewer metal fasteners than conventional airplanes, thanks to its reliance on structural adhesives, which in turn lightens the plane and lowers fuel costs. It's really scary. I'm flying in a plane that's held together by glue. That scares me. I understand there's some science people that get how that all works, but it's still scary to me. Okay, reconciliation of variable costing and absorption costing income. As noted earlier, variable costing and absorption costing net operating incomes may not be the same. In the case of Weber light aircraft, the net operating incomes are the same in January but differ in the other 2 months. I thought we just talked about why the two amounts differ. They differ because you have in the variable costing, the fixed manufacturing overhead costs get sent right to the income statement, whereas the variable costs go to the work in process. The opposite is for the absorption costing; it just sends everything to the work in process. So basically costs aren't realized for the fixed expenses. And remember, fixeds are things like factory rent, that's stuff that the monthly rent to be able to use a machine. If you're not counting that until it's not giving you a very accurate cost, right? Like if you're only what if you take months to sell it? Well, you're not realizing those costs until you sell it. So it could be really dangerous, I feel like. In the case, so as noted earlier, variable costing and absorption costing net operating incomes may not be the same. In the case of Weber light aircraft, the net operating incomes are the same in January but differ in the other 2 months. What that tells me is in January we built some things, and didn't sell them. These differences occur because under absorption costing, some fixed manufacturing overhead is capitalized in inventories, included in product costs, rather than being immediately expensed in the income statement, which is exactly what I just said. If inventories increase during a period under absorption costing, some of the fixed manufacturing overhead of the current period will be deferred in ending inventories. For example, in February, 2 aircraft were produced and each carried $35,000 in fixed manufacturing overhead. Since only 1 aircraft was sold, 35 was on February's absorption costing income statement as part of cost of goods sold, whereas the other, in variable, it was actually realized. In general, we kind of already talked about. Let's beat a dead horse. So this is the equation. Fixed manufacturing overhead deferred in inventory. Fixed manufacturing overhead in ending inventories minus fixed manufacturing overhead in beginning inventories. Ah, yeah, that makes sense. So this would be the change. This number would be, so if we say fixed manufacturing overhead in ending inventories, so we have 5 airplanes, and we started with 1, and we subtract 5 minus 1, we say, oh, we made an additional 4. The 4 is going to give us the amount that was, that's going to be the price difference between the two. So, again, note that the difference between variable costing and net operating income is entirely due to the amount of fixed over that is deferred and released from. Yes, beat a dead horse. Relation between pure production and sales for the period. Units produced equals units sold. Absorption costing net operating income should equal variable costing net operating income. Now, if there are more units produced than units sold, so if we produce more, if we produce 5 and sell 2, then what is that going to mean without looking at the diagram? Well, if we produce more and we sell less, that means that more of these, under absorption costing, more of the product is going to be not, more of the fixed costs of our manufacturing overhead is going to be in our inventory. So like the rent of our factory or the rent of the machine, it's going to be just sitting there waiting for it to be sold so we can actually see how much we owe or have paid. So basically what's going to happen is our absorption costing is going to be greater than our variable costing, because our variable costing is going to realize those amounts, right? It's immediately going to tell you, well, you've made this much, and the fixed costs are going to be in your income statement, which are going to increase the amount of costs, which decreases the amount of net income. Whereas absorption costing is going to increase the amount in your inventory, which is, that's going to be withheld, which is going to increase. So anyway, it's going to be, your net income is going to be higher with absorption costing. Now, let's say we sell more than what we produced. So that's an interesting concept. So we have inventory that's being sold, which is we're finally going to realize the manufacturing overhead, right, for those. But the thing is fixed costs. The thing with fixed costs is it's a set amount. So in our manufacturing, so in our work in process or our inventory, in our work in process or our inventory, what that means is we have these fixed costs which are not going to change depending on how many we sell, right? It just kind of depends on what month or period. It could be whatever periods you go by, but most companies use months. So let's say the month of January, I built 4, but in the month of January I sold 6. So what that means is I am going to under absorption costing, I'm going to finally realize those 2 that I said I built 4 but I sold 6. So 2 of those are from a different period. So I'm going to recognize those manufacturing costs, which whatever they may be, but I'm also going to get a bunch of revenue too, right? So I'd say it can depend. It can depend, right? But generally, I would say that your variable costing is going to be higher because you just made a bunch of revenue and you're only going to realize the fixed costs. You're going to recognize those fixed costs now. So your inventories are going to decrease, right? That means that you have less inventories than you made, so your inventories are decreasing overall. Absorption costing net operating income is going to be less than variable costing net operating income. They have a note here. I think this is important. Net operating income is higher under absorption costing because fixed manufacturing overhead costs is deferred in inventory under absorption costing as inventories increase. Net operating income is lower under absorption costing because fixed manufacturing overhead cost is released from inventory under absorption costing as inventories decrease. So, okay, that's a silly way of saying it, but it's not super silly. Like, basically, you're deferring the cost of the period, right? I built this phone in January and I sell it in February, but I'm not going to recognize the house or building I had to build it in, the cost of that house or building or machine. I'm not going to realize those fixed costs of the rent until I sell it in February. I'm deferring that cost. And then it's released under absorption costing as, yeah, like I said. It's saying the same thing, just, one's like, I release you, and one's like, I'm deferring you as you make it. I release you as I sell it. When units produced exceed units sold, absorption, and this is just gonna beat a dead horse. Let's look at this. This looks interesting. Manufacturers are constantly striving to maintain optimal inventories. If they make too many units, it ties up working capital. Whereas if they make too few units, it can lead to lengthy customer delivery times and lost sales. The same challenges hold true for merchandisers such as Seattle-based web retailer Zulily. Zulily, I think. The company has been ordering items from vendors only after its customers ordered them. While this approach helped Zulily avoid the need to store inventories, it also led to order delivery times ranging from 14 to 18 days, which pales in comparison to Amazon.com, QVC, and Overstock.com, whose order delivery times range from 2 to 5 days. Yeah, but I mean, to shorten its delivery times, okay, What this is referring to is something called drop shipping, which I'm surprised that they didn't actually name drop here. Drop shipping is when a supplier makes a connection with a vendor or a merchant, a someone who either creates the product or also stores the product. Because you might have someone at their house, even, which is how Amazon started, store product and ship it from their house. And that costs money to store it. So basically, you up the price a bit from what you bought and you sell it to someone else. Basically, that's drop shipping. On a larger scale, there's these mile-long warehouses that store millions of product, and someone places an order, someone's picking that order, putting it on dock. That dock is open to a big hunkin' trailer. That trailer drives it to a transition point or whatever. There's a million names, but basically another warehouse that sorts it into different categories gets put on another trailer and may go to another warehouse, eventually going to get sorted again to a more specific area, and eventually it gets delivered to a delivery partner, whether that be FedEx, UPS, or just a ragtag team that does deliveries. I call myself Blue Hawk deliver transportation or delivery, and you deliver it to my address and I go deliver it for a cost. And so you have this whole system, and all I have is a Lily. And you place an order on Zalily, and I make a deal with so and so, and they store the product, and they put it on a truck that goes through this whole process to get it delivered to you. Now, Zalily doesn't have overhead costs. Amazon has like insane overhead costs, right? Like they have to pay so much money to keep these buildings cool, not to mention clean. I mean, they have to pay all these workers to maintain the buildings. They stock the product, right? But because they stock the product in hundreds of locations, I think, probably not hundreds, but they do have quite a few locations, they can get it to you faster. And I think Wayfair is kind of the large parcel, like the big product, right? Like a couch, or if you're a dining table, statues, big things. They sell other things too, but um, they can get big things to you, right? And they also have large amounts of buildings. Anyway, so drop shipping. Overstock is kind of like a Wayfair, but I don't think they're doing too well. Let's look at that. Overstock stocks. Hey, I think they got a boost in 2020 when everyone went online. But look at this, they were at like $5 a share. I bet you Wayfair got a boost. Yeah, 2020. Like they went from $27 a share to like, and they're at 324. $2020, they got a boost from 2000. Now they're at 3,200. Let's see if we can find Zulily. Are they out of business? Oh. Yeah, I think they got muscled out. Old news. To shorten its delivery times, Lilly decided to order and store items from vendors prior to their sale to end customers. The way I said that, prior to sale to end customers, they're gonna end you if you buy from them. That would be funny. The goods would not be recorded on company balance sheet. The vendors will continue to own the merchandise stored in Zulili's warehouses until sold to end customers. That's a weird business model. I'm glad they're restructuring. Like, I'm gonna store it here, but you're gonna own it. And I'm just kind of eating the cost of storing it. I would just keep drop shipping. I know it kind of sucks, but I mean, it doesn't, I don't know. Trying to compete with Amazon, I think. All right. Advantages of variable costing and the contribution approach. I think we can safely say that we understand the benefits here. We can basically get live info, right? Like when I make a sale, I know how much I'm paying out of that month already. Though I do like here, it looks like they're doing a CVP analysis, which I could use some practice with, always. Yeah, so it enables CVP analysis. Cost volume profit analysis requires that we break down costs into their variable and fixed components. Because variable costing income statements categorize the variable and fixed, it is much easier to use this income statement format to perform CVP analysis than attempting to use the absorption costing format, which mixes together variable and fixed. Moreover, absorption costing net operating income may or may not agree with the results of CVP analysis. I don't know why that matters, but like, yeah, why do we need to make it agree? I don't care what the absorption costing net operating income says. This is my CVP analysis. Okay, so dollars to attain target profit. Target profit plus fixed expenses divided by contribution margin ratio. B divided by A gives us the ratio. Target profit plus fixed expenses. 235. We would need to sell 500,000. And I hope they do units. They don't. I guess. How much? Guess we'd need more info, but yeah, again, the reason is that under absorption costing, net operating income can be distorted by changes in inventories. Let's beat a dead horse. All right, explaining changes in net operating income. The variable costing income statements are clear and easy to understand. I agree. All other things the same. When sales go up, net operating income goes up. When sales go down, net operating income goes down. When sales are constant, net operating income is constant. The number of units produced does not affect the net operating income. I mean, Okay, I think all other things the same. I can agree with that statement. I mean, the number of units produced does not affect the net operating income. I think so many people would disagree with that statement. But all other things the same, sure. Whatever that means. I think you're saying specifically assuming that direct labor, direct materials, and manufacturing overhead uh, per unit, as long as that is the same, while when sales are constant, net operating income is the same. When sales are constant, the number of units produced does not affect the net operating income. It's still not true. Like, if you make 10,000 phones, you have to pay for direct materials, direct labor, variable manufacturing overhead, and fixed manufacturing overhead. And that's not even, I'm not even talking about selling it yet. That costs money. If I make 15,000, that costs money. If I make 100,000, that costs money. The number of units produced does affect the net operating income. Anyway, moving on. Absorption costing income statements can be confusing and are easily misinterpreted. Agreed. Look again at the absorption costing income statements in this image. A manager might wonder why net operating income went up from January to February, even though sales were exactly the same. Yeah, a manager might wonder that if they don't understand absorption costing. Was it a result of lower selling costs? Why are you changing the price? More efficient operations, or was it some other factor? In fact, it was simply because the number of units produced exceeded the number of units sold in February, and so some of the fixed manufacturing overhead costs were deferred in inventories that month. These costs have not gone away. They will eventually flow through to the income statement in a later period when inventories go down. There's no way to tell this from absorption costing income statements. To avoid mistakes when absorption costing is used, readers of financial statements should be alert to changes in inventory levels. Let's answer some questions. We've been at it a bit. Two general costing approaches used by manufacturing to prepare income statements is absorption costing and variable costing. Variable costing income statements are based upon a contribution margin. I really don't want to get this. Is it product versus... Yeah. Haha. Okay. When using variable costing, fixed manufacturing overhead is period cost. Put her there manufactures baseball gloves. Each glove requires $22 of direct materials. Write this down. 22, 18. Variable manufacturing of 7. 22, 18, 7. 19 of fixed. Variables 11. And fixed is 13,200. So let's do some math. So at 13,200. Okay. 22, 18, 7. The unit product cost using variable costing. That's 47. Did all this math for nothing. Costs are separated between variable and fixed expenses when using variable. For external reporting, income statements are generally prepared using well, I guess it's using absorption, because this one's definitely variable. True or false? Absorption costing and variable costing always result in the same net operating. That is so wrong. Next question. The difference between reported net income on variable costing and absorption costing income is based on the statement's formatted, fixed overhead, expenses are organized, cost classifications are defined. It's fixed overhead. Using variable costing and the contribution approach for internal decision making enables CVP, supports that, facilitate changes. Variable costing treats manufacturing overhead as a period cost. Financial statement users need to be aware of changes in inventory levels when using absorption. Frames Incorporated manages large wooden picture frames requiring $19 of direct materials, 40 direct labeler, variable manufacturing overhead of 9, and let's add that up. 68 and 13. Company produces 5,000 units each month. 15,000 of fixed overhead. The unit product cost each frame is 68. When a segment is eliminated, a traceable fixed cost will disappear. Segment, we're not there yet. But we did answer some dang good questions. Let's read about this concept. Let's go back. How far are we? It's the next page. Let's read about this. Low 6-4. Segmented income statements and the contribution approach. Prepare a segmented income statement that differentiates traceable fixed costs from common fixed costs and use it to make decisions. Well, we're going to learn some things here. In the remainder of the chapter, we'll learn how to use the contribution approach to construct income statements for business segments. These segmented income statements are useful for analyzing the profitability of segments, making decisions, and measuring the performance of segment managers. Traceable and common fixed costs and the segment margin. You need to understand 3 new terms to prepare segmented income statements using the contribution approach. All right, let's write these down. Traceable fixed costs. Traceable common fixed cost. And segment margin. All right, first and foremost, whoops, here we go. A traceable fixed cost of a segment is a fixed cost that is incurred because of the existence of the segment. If the segment had never existed, the fixed cost would not have been incurred. And if the segment were eliminated, the fixed cost would disappear. Examples of traceable fixed costs include the following. So a traceable fixed cost of a segment is a fixed cost that is incurred because of the existence of the segment. What is a segment? That would be my first question. Okay. What is this bell? Do I click on that? No. Cool. The salary of the Fritos product manager at PepsiCo is a traceable fixed cost of the Fritos business segment of PepsiCo. Okay. Okay, I wrote down salary of product manager of business segment. Cool. The maintenance cost for the building in which Boeing 747s are assembled is a traceable fixed cost of the business segment of Boeing. Okay. All right, maintenance cost. Okay, maintenance cost of business segment. The liability insurance at Disney World is a traceable fixed cost of the Disney World business segment of the Walt Disney Corporation. Okay. So I got salary of a product manager of business segment, maintenance cost of business segment, liability insurance of business segment. Something that I noticed with all these is business segment of the company, right? A common fixed cost is a fixed cost that supports the operations of more than one segment. Okay. Okay. I'm going to put that inside here. More than one segment. Cool. Salary of CEO. Of various divisions. Okay. Cost of heating. Cost of heating of various departments. The cost of the receptionist salary. I like that. Salary of receptionist. Of various doctors. Okay. So a common fixed cost is basically a cost that's shared more than one segment. What about segment margin? Oh, that's coming up. To prepare a segmented income statement, variable expenses are deducted from sales. I'm going to write that down. Put that down here. Prepare segmented income statement. Variable expenses are deducted from sales to yield a contribution margin for the segment. Okay. Yeah. All right. Sales minus variable expenses equals contribution margin for a segment. Okay. Okay. The contribution margin tells us what happens to profits as sales volume changes, holding a segment's capacity and fixed costs constant. The contribution margin is especially useful in decisions involving temporary uses of capacity, such as special orders. These types of decisions often involve only sales and variable costs, the two components of contribution margin. The segment margin is obtained by deducting traceable fixed costs of a segment from the segment's contribution margin. Aha. Traceable fixed costs. Hey, I'm still working here. Calm down. Just writing down notes. Um, see if we can finish this. How many pages we got? Identify. That's not bad. Okay, we've been going at this for an hour and 15 minutes. Okay, we're gonna take a little break, eat some lunch, and hit it again.